Good morning and a warm welcome to all. I am Vikash and part of Optymoney. Just to give you a quick update on Optymoney, Optymoney is an individual financial management platform, uh, which is automated individual financial management platform helping users in their journey of financial self-reliance. Today we have a guest speaker, Tanmaya Desai from SBI Mutual Fund, who is going to enlighten us on the developments in the pharma and the healthcare sector. I'm happy to introduce Tanmay, who is an who is a engineering graduate in electronics, and he has a master's in finance from Nasimuji Institute of Management. Prior to doing his master's, he had worked as a software engineer with Patni Computers and also worked as a lecturer in electronics department in a college in Mumbai. I thanks Tanmay to accept our invitation and talk and give us more information on what's really happening in the domain of pharma and healthcare. Over to you, Tanmay.
Hello friends. Good morning to everyone, and thank you, Vikas ji, for an elaborate introduction. First of all, I would like to wish all of you are safe and healthy in such testing times. I believe the current time is pretty challenging, and hence, we should pray for the safety of one and all. Uh, so, in light of the current COVID-19 pandemic, and also looking at the kind of move that we have seen in the pharma sector, I believe all of us have gathered to understand the outlook on the sector and how one should go about investing in the same. As Vikas ji mentioned, I have been associated with SBI Mutual Fund now for 12 years and have been managing the SBI Pharma Healthcare Fund for almost 9 years as we speak. Let me construct my discussion by delving a bit into the history of the sector, as well as what is happening on COVID-19 front, what is the impact on the pharmaceutical companies, and how are they addressing some of the practical difficulties on account of COVID-19. I will also like to present a sector outlook, a broader sector outlook, and finally also provide a glimpse on the structure of our portfolio, along with what expectations we have going forward. Post which we'll open it up for some questions that I'm sure my friends who are out here would be having. So just kicking off the discussion, a bit of history on the sector. Let me kind of particularly pinpoint a point in time just prior to COVID, where the sector, of course, had a serious underperformance in the preceding 3 years. And even with whatever 30% odd move YTD that we have seen in the sector returns on a CAGR basis for the last 3 years are at 9%. Yes, better than the broader indices, but they are still but the sector is still underperforming on a 5-year basis. This is, when we do compare this with the earnings growth in the sector, again, prior to COVID, has been pretty muted, only at around low single digits. And there have been a slew of headwinds which have impacted the sector. Let me highlight a few of them to put this into better context. So if we look, the entire story on growth for the Indian pharmaceutical sector came on account, the exponential growth for the sector came on account of US, and the worries for the pharmaceutical sector starting 2014-15 also started with the same sector, same segment, which is US, which is the largest pharmaceutical market, and with channel consolidation as well as the heightened price erosion and the scrutiny of plans for Indian pharmaceutical companies, which went to a different level, led to the kind of underperformance that we saw in the sector. It also wasn't helped by the fact that our base in the US is materially large now. Unarguably, the scrutiny isn't out of context, as outside the US, India is the largest player with almost 40 to 45% of share in the generics space by volumes. The second most important business for pharmaceutical companies is India, and the price action in India, led by the regulators, impacted the price in 1 year. Then we also had the impact on account of GST, which led to inventory readjustment. And in general, the volumes are also low for the sector in a healthy year. Net net, a segment which was growing in double digits at around 12% grew by only 7-8% in the same 3 years that we are referring to. Discussing India and US is important simply because they constitute almost 75% of business and maybe even a larger chunk of profits for Indian pharmaceutical companies, and hence earnings as well as valuations took a beating in this period. To kind of now tie this up with what has transpired, again, even prior to COVID, the growth in India to some extent had normalized, and there were positive trends which were seen in the preceding couple of quarters. Our belief is that barring Q1, which will see a lot of disruptions, starting to some extent with logistics and the fact that patients are actually not visiting doctors and the elective surgeries are not happening, there is a fair bit of expectation of growth momentum in the India business to kind of continue. At the same time, we believe that the issues in the US are largely in the base, and the price erosion, which used to be in double digits, has now stabilized to around 5-6%. At the same time, the shortage of drugs in the US is increasing day by day, simply because a lot of pharmaceutical entities in the US find it unviable to continue manufacturing. In fact, nobody is talking about pricing in US at this point. Everybody is talking about consistency of supplies and securing the same. While scrutiny is not something which should be taken for granted, clearly because the regulators would not travel in such testing times, the scrutiny is expected to be lower in the near term. But in the long run, we believe that the scrutiny for the pharmaceutical companies is going to remain high, and companies need to be agile to adapt to ever evolving requirements of the regulator. At the same time, the base of Indian companies in US is by no longer small, and that could curtail our ability to grow in the US at the same pace at what we have grown over the last year or over the last decade or so. I think the most important aspect which has changed, and what I'm sure everybody wants to hear, is on the COVID-19 pandemic. Most of us have been reading on the developments around COVID-19, but the fact of the matter does remain that it is a serious infection, one which is highly transmissible, and one which does not have any clear medication as we speak. Globally, while the treatment regime is far better today than what it was 3 months back, clearly evident from the recovery rates that we are seeing across countries, but the danger is far from over. The fact of the matter, yes, is that there are too many unknowns around COVID-19 with respect to the medicine, the transmission rate, probably a second wave, what could possibly be the cure for timeline, and when a vaccine comes, to what extent it can offer an immunity. Work is definitely going on in quite a few areas. Let me highlight a few of them. On the drugs front, as I mentioned, the regime is of course better today than what it was 3 months back. There are at the same time 50 or more drugs on which the work is going on, but the effort is largely towards repurposing the existing drugs with known safety profiles. Simply because it's too difficult to kind of come up with a medication today. Generally, it takes a hell lot of time to come up with a proper medication. At the same time, vaccines also could possibly take some time because there are certain trials and one needs to prove on the safety and the efficacy front. On the drugs, yes, there are antiviral, there are immunity enhancement, as well as the antibody-based treatments using the plasma therapy, on which work is going on. On vaccines, we keep hearing about more than 100 such candidates on which the work is going on. But to give you a statistic which is not so very encouraging is that, and this is quoted by a very well-established company, that is Merck, that over the last 25 years, only 7 new vaccines have hit the market. And there are certain diseases like HIV, hepatitis C, even SARS for that matter, which did not have a vaccine. Vaccines do need to undergo a lot of clinical work to ensure the safety profile, and hence our assessment suggests that vaccines are still 6 to 12 months away. Yes, there are a number of vaccines which are at various stages of development, but there are companies like Moderna, Pfizer, AstraZeneca, and Sinopharm, which is interestingly a Chinese company, which are well ahead in the race, and they do make claims of a vaccine by the end of this year with commercial availability by the middle of next. However, I mean, for things to still go right, not just one, but many more vaccines need to be successful at the same point in time, considering the spread rate that we are kind of seeing at this point in time. Lastly, and the most important one is on the diagnostics. I think the best mechanism to kind of be away from the fear of COVID-19 is to continue maintaining social distancing, continue better hygiene in general, and to keep doing more and more testing. Uh, Testing, of course, I'm sure a lot of people would be well aware, is of two types. One is the PCR-based test, which is the far more accurate testing mechanism, and the other one being antibody, which is the rapid testing. In pockets of the country, the testing has kind of materially picked up, but I was also mentioning to Vikasji that there are still some pockets where the testing is not absolutely done to the level that it probably needs to be done. And in times to come, we will see, in fact, an elevated level of testing, which is pretty much important to ensure that you are able to catch the asymptomatic patients at a much earlier stage, or even the ones which do have minor symptoms, so that they can be treated better. The conclusion that I'm trying to draw out here is it's very difficult to determine when India will hit a peak or when the globe will have a certain peak. This control of the spread is more important than to think about an immediate cure. And the fact of the matter again is that with so much of uncertainty, one needs a safe haven, and pharma being classified as essential goods with the supply chain and the manufacturing in place, I think pharma is the sector where the prospects of growth are going to continue remaining better, and hence makes for an interesting case of investment, even with or without COVID from a medium to long term perspective. Yeah.
Sorry, Tanmay,
Yeah,
I would like to come here and ask a few questions which I've
sure,
been getting on my personal side.
sure.
See, pre-COVID and post-COVID, where do you see a change in the whole sector? Which part of the pharma and the healthcare sector you see more promising?
Okay, I'd like to divide the answer into two parts. If I look at it from a short to medium term kind of perspective, then we do see opportunities to be more in the exports market. Simplistically dividing, India is around 30% of the total sales for the pharmaceutical companies, and exports is around 70%. A large chunk of that 70% is in the US. Now, be it our low cost of manufacturing, be it the tailwind also on account of the currency, and in general, the demand which we see right now in the US or in Europe, the prospects of growth is definitely better post COVID in the near term from an exports market perspective. Having said that, to kind of highlight a concern out here is when we take US as an example, our share in US is not small. We are 40 to 45% of the volumes in the US as we speak. And hence our ability, and this has happened, like if I have to say track back a decade, our market share would have been 10%. And hence the bulk of the great growth or the exponential growth that we talk about is something which has already happened. It may continue. Our market share may actually move from 45% to 60%, but we will definitely hit a roadblock in in US in particular in some time. The second part to my answer is that even prior to COVID, barring whatever were the hurdles that we saw on account of pricing or GST, the growth in India by and large has been good. If I take it over the last decade, the growth has been 10, 12%. Yes, a function of pricing and a function of lower volumes, it has come down. But here we see more stability and more resilience from a longer term perspective for n number of reasons. One is the increase in the lifestyle diseases, as well as two, the low level of penetration that we see in kind of India, and three, the lower accessibility to medicines today, which is definitely going to increase as there is more and more awareness. So from a medium term perspective, we are more optimistic on exports, but from a longer term perspective, our belief is that the growth story in the India territory, or for that matter, any branded geography, is going to be better. This, of course, includes even healthcare services, which is hospitals and the diagnostic companies.
Yeah. So my question is again, whether the diagnostic hospitals or it is the specialty chemicals. So which sector do you see more promising from an investor's perspective within the
Uh,
domain?
Okay, I would have a straight answer to that. If you ask me on a more linear basis, the domestic formulations area is the one which is going to is has had promise and will continue to have promise. On the specialty chemicals front, and I'm tying some specialty chemicals to the API business in general, which is the theme of the day, in light of what's happening with respect to relationships with China, our over dependency with China, and the recent announcements which have happened around specialty chemicals on the API front. I think this is also going to be an area where the growth is going to have more promise, at least over the next 3 to 5 years. But I believe that the shift purely coming from China to India is not going to be as fast as what one anticipates, simply because the kind of incentives which have been doled out are not sufficient enough for an Indian pharmaceutical company or a large pharmaceutical company in general to look for large scale investments in the sector. If they are good at XYZ aspects of business, they would look to scale that up because the business is shifting away from China to India, but they would not look to invest in a greenfield because there are certain incentives, because the 10 to 20% kind of incentives which have been offered are not too lucrative. We will see more SMEs looking to kind of invest in this space. From the just to complete this, just on the healthcare services also, because you asked about diagnostics as well as the hospital companies. Their near term definitely is going to be challenging because patients are a little bit more fearful. But at the end of the day, one cannot run away from not doing an elective surgery. So this is also an area which is far more sustainable in terms of growth in our assessment.
So what you said, the kind of incentives provided are
Mhm.
not good enough. So what do you think would be a good incentive for a investor to come into the SMEs or the large companies to set up a bigger or larger capacities of production?
The differentiation in the costs between us and China could be anywhere between 30 to 40%. It's as high as that. And the incentives which have been offered on the fermentation based products, where China is really strong, is 20% for the first 5 years, falling off to something like 15% in the sixth year, and then subsequently much lower in the following years. On the pure chemical kind of APIs, the incentives are only to the tune of 10%. What I'm trying to highlight is, to give you an example for that matter, in the cephalosporin basket, which are the antibiotics, or in the antiviral products, there are companies like say an Aurobindo or a Lupin, which are extremely strong, and they wouldn't need a incentive to go out and invest in a greenfield expansion. They already have an investment. They would look to scale that up because there is a customer who wants to move away from China and come to the next best geography, which probably in their opinion is India, because of the skills in chemistry and the low cost of labor. Mind you, the cost of labor in India today is lower than what it is in China. But the advantage that China still continues to have is their capacities are 10 times what it is in India. and hence we are unable to meet the kind of cost out there. Another example is say erythromycin, where Alembic Pharma as a company is present and they are expanding their API capacity in this space. They could benefit, but again these are not going to be companies which will look to invest in those zones or parks which the government is kind of highlighting through the 10,000 kind of 10,000 crore investment which they have outlined.
Okay. So now, in terms of the pharma companies,
Mhm.
where do you see the listed pharma sector in India?
Mhm.
Which category do they really fall into from a
Mhm.
long-term investor perspective?
Mhm.
Whether if you still look at the mid-cap pharma companies or which mid-cap or a large-cap. So if you can just elaborate a little on that.
So the beautifully how the pharma sector is kind of constructed is that the large cap pharma companies have almost more than 40% of their business which is coming from US. And as I was kind of mentioning as part of the discussion is that the prospects of growth in a geography like US or in Europe looks to be far more promising today and should remain true for at least the next 12 to 18 months. Hence, there is more lucrativeness to invest in the large cap pharma space today with a 1 to 18-month kind of time horizon. When it comes to mid caps, the ratio is exactly the reverse, where we have companies like an Alchem or a Torrent Pharma or an Alembic Pharma, where domestic is only a small fraction of the business and exports in general in totality. India is a much larger pie of the business. So for an Alchem, India is around 75%. For Torrent, it is 55%, and so forth. So greater than 50% of the profitability for the mid cap pharma is coming from India. These are good bets from a long term perspective, no two doubts. But in the near term, with all the kind of disruptions that we would see in India, and just to quote some of the agencies, the growth in India this year is expected to be kind of flat vis-a-vis last year. These are companies which might underperform at least in the near term, but from a longer term perspective, we would look to again go back to the investments in the mid cap space. So specifically to answer your question, near term we are looking at large caps because of their export oriented focus. But when we think of constructing a little longer term portfolio, we would not shy away from again investing back into mid caps and the hospital companies in general, because for them the worries would start kind of waning away as time progresses and as COVID-19 goes away.
Okay. So basically, if I can understand, next 12 to 18 months would be for large cap and investors looking at beyond 18 months to maybe up to 5 years of kind, it would be good to invest in mid caps.
Absolutely.
Right.
Absolutely.
Okay. And now one more thing, how does the whole insurance, because the hospitals, as you said, would
Hmm.
be kind of getting the benefits maybe post the COVID is improving. So how do you see the role of insurance in the domestic market, helping the case for hospitals?
Oh, definitely. Insurance would play a very important role. But the way India as a country is, still the kind of out-of-pocket payment is significantly higher. When we look at it from a developed world perspective, where 95% would be insurance driven and out of pocket is 5%. From whether you talk it from a pharma perspective or from hospitals perspective, the ratio is going to be exactly the opposite, where 85% of what Indian consumer has to bear is out of pocket. Right. So what I'm trying, and the fact of the matter still is that when we compare the pricing, be it in terms of treatment in India or for that matter drugs in India, we are still a small fraction of what it might be in the Western world. So what I'm trying to say is, while it just gets kind of always highlighted that the cost of medication or the cost of treatment in India seems to be very high and it is pinching the pockets of an end consumer, we still are not one of the high-priced geographies. So in our assessment, while insurance will play a very, very important role, but the transition towards a far deeper penetration of insurance is going to be a slow race. space. On the pharmaceutical side, definitely. On the hospital sides also, almost, if I'm not wrong, 40% of the patients are still cash patients, which is a substantially large number to start with. Uh, so yeah, insurance is going to play a material role. You take the case of even Ayushman Bharat, which has touched the families of n number of whether you call it low level or the middle level consumers, but definitely it is going to allow to reach the doors of the Indian consumer in a far better fashion.
So now, just trying to understand from a perspective, as you are managing the pharma and the healthcare fund for SBI, so where are you positioning that particularly?
So as I said,
Yeah.
so let me answer this question from two data points. Like I was mentioning that it looks good from to invest in large caps from a near-term perspective and mid caps from a long-term perspective. If I see the coverage ratio of our pharma fund vis-a-vis the S&P Pharma index that we have, the coverage ratio is as high as 65 to 70% today, which means that our fund is significantly inclined or positioned towards investing in the large caps today vis-a-vis the mid caps. So I would say that almost 60 to 70% of our investments are today in the large cap space, and 40% or 30 to 40% of our investments are in the mid cap to small cap space. The other statistic, and I think that could probably make this a little bit more clear, is that let me divide, rather than doing it from a large cap, mid cap, small cap perspective, let me do the division across geographies. What we have done is we have looked at all the companies and looked at what percentage of their business or profits is coming from various geographies, and tried to arrive at the figure as to what percentage of our portfolio is spread across what geographies. So 30% of our investments today is in India, which includes the healthcare services, that is the hospitals and the diagnostic companies also. Almost 35% of our investment is in the US. 20% of the investment is in the other regulated markets or semi-regulated markets. Just to kind of give some examples, it could be Russia, Brazil, Mexico, and some territories, say in Africa. 10% of our investments, which is expected to increase, is in the API space, which is the specialty chemicals or the basic chemicals which you were asking about. And around 5 to 10% of our investment is into contract manufacturing companies like DPs. I think this probably could, this is generally what helps me in explaining.
Absolutely. So, I mean, in the recent, I've been hearing and reading a lot about the specialty chemicals business having a high potential.
Hmm.
So, where do you think, and do you think there is a scope for your fund or any other fund to kind of increase their exposure, and do you see that potential?
Absolutely. We are very keen to increase our exposure in the API slash specialty chemicals space. Unfortunately, there are very few dedicated 100% API companies. Case in point, there is a Solara, which we have as part of our investment. The other entity is DVs, which is well known, well discovered, which is also part in our portfolio. Barring that, most of the formulators, the companies which have presence also in India, US, the way we were kind of explaining, also do have a material business in the API. To give you certain examples, we have an Aurobindo, we have Dr. Reddy's, Alembic Pharma, IPCA, are excellent companies on the API space, and they do a significant amount of backward integration into their final product through API, which is also where we have increased or are scaling up our investments. But it is an indirect investment because they not only have APIs, they have other businesses also. But yes, there is definitely scope to increase. There are a bunch of companies which are specialty chemicals but may necessarily not fall in the bracket of pharma, simply because they have a very small percentage of investment, less than 10% into pharma. To again give you a case in point, the recent listing of something like a Rosari Biotech, 90% of their business is not in pharma, and the 10% which is also there is into animal healthcare and nutrition, right? very keen to look at a company like this, but our mandate will not allow us to invest in a company simply because whatever they do, hardly anything goes into pharma. But that's a theme which is the concurrent theme, the one where people are extremely keen to kind of invest. But yeah, there are going to be a lot of small size companies which could possibly come for listing on the API space, and we would be very keen to enhance our investment on the pharma side out here.
Right. Now, one question, Tanmay, in terms of specifically when you look at a pharma company,
Mhm.
pharma or a healthcare sector company, is there a specific PE which you you look at, or how do you decide what is the right investment fit for a fund like yours?
No, it's a great question, and fortunately or unfortunately, I've seen two cycles now in the entire pharma space. When I started my career, people were willing to ascribe not more than 10, 12 PE to pharmaceuticals, and all the way up to in 2015, where even a 25 to 30 PE was where what people were fairly kind of comfortable. It kind of corrected materially to again 15, 16 times, and today it is back to something like a 23, 24 times 1 year forward kind of earnings multiple. The way I would like to look at it is again best to divide the entire business into two buckets: India and non-India. The India piece is very much branded. It has consumerism in its whole flavor, simply because the growth is far more secular. There is a doctor who is deciding the brands, and at the end of the day, 85% of the medicine buying is out of pocket by an end consumer. It is very much similar to FMCG kind of a business, just that in case of FMCG, the end decision maker is you and me. In case of pharma, the end decision maker is the doctor. So I would say that India as a business, by and large, is expected to receive a much higher PE multiple because the growth is more secular, the profitability is higher, and the investment required is far more lower. When we go into non-India geographies, be it US, Europe, or for that matter, even API business, it is more capital intensive business, and it is more generic, and it does not involve a brand. And if we compare then with the multiples that companies sitting out in the US are getting, and even if we say that Indian pharmaceutical companies should get a slightly higher PE, still the PE for this business is going to be much, much lower. What I'm trying to say is, and if I am allowed to give you numbers, I will be happy ascribing even a 30 multiple to an India business, a 30 PE multiple to an India business. But when I look at US, where the growth can probably stall in 3 to 5 years, a 10 to 15 PE multiple is something beyond which I would struggle to kind of give, because again, as I said, the growth is not there. The profitability will have a lot of volatility, and the return profile is also less. So it's inferior to that of India. If I blend the two, I'm happy to still ascribe a 20 to 24 kind of PE multiple to the pharmaceutical companies even today, which is what the multiples that the companies are getting today, and hence it is good to chase the earnings growth story in pharma today. I don't know if I have been able to kind of
I think it's very precise. So now, from a context, basically, if you look at from an investor's perspective, is
hmm.
it that he should take a bigger exposure where funds are more from a investing in a domestic story of pharma or healthcare, or in a global context? So basically, which context should one choose, the domestic or the global?
I think as an investor coming into a thematic fund like pharma, they would like to invest and remain invested for a slightly longer duration of time, so they are able to capitalize on at least one good cycle in the pharma space. If that is the case, then clearly they should evaluate a fund which is having a more domestic oriented kind of focus, simply because the growth is going to be secular and is going to remain plus or minus 2% in general. The current COVID-19 situation is far more challenging and dramatic, and hence it calls for changing philosophies or changing investment styles for the short term. But if I have to kind of give a very pinpointed answer, and that was what the kind of theme we were running prior to COVID also, is to have a significantly higher contribution towards domestic oriented companies. To give you our own fund perspective, investment in US was only 15%. Investment in the ROW geographies was only 15%. So 30% of the investment only was going into those areas. 70% was in the growth areas, which is India or some of the other branded markets by and large. That changed in the recent times where we had a significant rejig or a reshuffle in our portfolio. But if we are to have this discussion 1 year down the line, I think our portfolio again will have a material domestic flavor, which is what I believe, and uh, I'm a ardent believer in general.
So basically, you're saying the Indian domestic story is bigger than the global for Indian investors.
The global story is big, but we have already captured a good part of that. If we
Okay.
are 45% of share by volumes in US, we cannot keep growing there, and it's a well penetrated market already, where generic medicine is 90% plus penetrated. Now, in Europe, we can have our growth, but in Europe is not just one territory. Unfortunately, it's a mix of so many animals at the end of the day. So our ability to kind of succeed consistently is going to get questioned sooner or later. India is a home territory, right, and an underpenetrated area. So the challenges to growth in India are going to be lower. Let me put it slightly differently. While I think the growth in India is going to be closer to 10%, it is going to remain at that for a long point in time. When we talk about some of the regulated markets, the growth can be 15% or it can be 0%. And hence it becomes challenging for an investor to necessarily absorb a year where the growth is going to be closer to 0%.
Okay. So now you said in the last 3 to 4 years, the growth has been 7 to 8%. So now moving
Mhm.
forward, what is the kind of growth do you see for this sector for the
Mhm.
next 3 to 5 years? Are we
Uh,
in the second bull run for a pharma story?
Uh, well, a part of the bull run has already got captured when we look at it from a 30% return YTD or 40% return, from a 1 year perspective. So I would say that the valuations are not unreasonably cheap any longer. However, I believe that the valuations are not going to correct from the current levels that we see, and hence the earnings growth story is going to be far more important to pitch as a story rather than assuming that pharma is an undervalued sector, which we no longer believe is the case. Coming to the question on earnings, I think that again, let us divide the business into, say, India and the rest of the geographies. I think the growth in India in double digits from a profit perspective is a very safe assumption, versus the 7-8% which has been the growth in the last 3 years, barring FY21, which is going to be impacted by COVID. On a secular basis, the growth in India is going to be closer to 10%. And as the share in the chronic segment kind of increases, the profit growth could be anywhere between 12 to 15%. So we would like to pick and choose companies in the chronic space because the growth is far more better. When we come to the non-India part of the business, we believe that a single digit growth is what is going to kind of happen. As Indian companies move up the curve on the specialty side, be it on chemicals or in the final product, the profit growth could be somewhere closer to 8 to 10%. If I then marry the two, I think the sector is good to deliver a 10 to 12% kind of earnings growth over the course of the next 3 to 5 years, which is a kind of safe CAGR return an investor can look to expect from the sector going forward.
Sure, sure. So, I mean, that's good to understand.
Yeah.
Uh, if audience has any questions, maybe they can also ask. I've been asking on behalf of the audience whatever I received few in advance from the thing. You can carry on, Tanmay. Give us
Sure.
a little more details of what we can further expect in this sector.
Sure. What I will do is, in the interest of the audience, I would like to highlight how the near term is expected to kind of pan out. While we are constantly hearing about what challenges other sectors, be it on the industrial and the manufacturing side or on the automobile side, have been facing. Initially, there were also certain challenges which were witnessed on the pharmaceutical side, both in terms of the labor attendance as well as on the logistics front. But the two things which I wanted to kind of highlight is, while these logistic things seems to have been particularly resolved, there could still be some disruption which could be seen in the first quarter, as well as to some extent maybe in the second quarter, as we kind of see a second wave of lockdown. While pharma is classified as essential, sometimes the cross borders are always going to create some issues. Again, this is kind of going to play out well for the exports business, simply because from an exports perspective, pharmaceutical companies in general tend to keep a 2 to 4 month kind of inventory at their warehouses in the export countries. So while whatever might be the near-term logistics issues, their inventory sitting out there is going to allow them to continue delivering on growth and hence grab market share at the expense of a European company or a US company which is facing lockdown in their geography. So I believe that in the near term, the growth is also going to be strong because we have better supply chain benefits out here. From a little bit Q2, Q3 kind of perspective, I think as the lockdown is kind of opening, the hospital companies and the diagnostic companies are also going to have better levels of occupancy. Generally, they tend to break even at around 50%, and they currently are at around 55-60%, and that is only increasing as we speak. The basic assumption is that as we move into Q3, Q4, we will see some forms of normalcy, with FY22 expected to be a far more normal year, because ailments cannot get postponed, treatments hence cannot kind of get postponed. Yeah, from a near-term perspective, as I mentioned, exports is going to again benefit on account of all these softer aspects, but again, growth is going to bounce back for the domestic sector as we move into Q3, Q4.
I mean, there's a lot of appreciation coming in the chat box, which I can see. People are really liking the whole session and the knowledge which you have shared with all of us. I don't see any much questions. Mr. Aman, I believe he wants to ask, but he has not put any question in the chat box. So, one second. He has raised his hand, but he has not put his question. Yeah.
Okay. To just kind of complete the discussion, and to kind of give examples purely out of the portfolio that we have kind of constructed, the large cap companies like say a Sun, Dr. Reddy, Lupin, Aurobindo, and Cipla, which almost form 50% of our portfolio today, are the ones to necessarily benefit in the near term, precisely for all the reasons which I kind of highlighted. Some of these stocks actually were not part of our investment 6 months back. I mean, not to the proportion that we own them today, which is again just tying back to the fact that we are looking to expect them to benefit more at the expense of the others. From the mid cap kind of perspective, the companies which I would want to highlight are someone like Torrent, Alchem, and Abbott India, that is an MNC, Alembic Pharma, and Ajanta. They have a decent 50% kind of profit contribution coming from India, but they also have an export space which is kind of doing fairly okay. But probably these are companies which in the near term may garner less interest, but are companies which, if one is comfortable to own from a 3 to 5 year perspective, would definitely yield rich dividends as we speak. I would say from an API perspective, as you have already asked, and I tried to elaborate on that, that there are very few companies, but Divi's is a classic example of what to do correctly in an environment, whether it is pre-COVID or the current.
Yeah. So where do you see the diagnostic sector? How do you see the future of diagnostics in India?
I think
Because penetration and the rural has a high demand, but we don't have the facilities. So how do
Yes.
you see that area panning out?
Extremely promising for the private organized chains for few reasons actually. One is them being having an established channel and chain. Their brand is kind of getting far more recognized as they are kind of penetrating deeper into territories, especially in the east as well as in the south. To give you a kind of a broader statistic, all the organized private companies, they form only 15% of the or 17% of the total diagnostic companies business, diagnostics business in general. And this is a business which is kind of growing at 12-15% simply for all the reasons that you kind of highlighted, that a the penetration is lower, people are kind of becoming far more aware about health. To give you a stat again, on an average in India, the number of tests done by an individual is almost close to one, or not even that much. But when you move to a far more penetrated market or a health conscious market like Delhi, the number is three. When you compare it to a developed market, the number of tests done is like 7 or 8 in a year. It just kind of highlights as to what is the scope of growth possible for the diagnostic companies in kind of general. I think this COVID environment is going to result into a wave of consolidation, because not all small diagnostic companies are going to survive, which could actually benefit the listed organized large players like a Dr. Lal, Metropolis, Thyrocare, or even some of the unlisted players like Suburban Diagnostics. And they should probably grow much faster than the underlying industry post the COVID situation normalizes.
You have actually answered my next question, which I was about to ask you on the consolidation opportunity in this space. So now, Tanmay, there is the one is the so-called physical healthcare infrastructure, and now the
Mhm.
new generation companies which are coming up, which
Mhm.
are go to home and do your tests. So where do you
Mhm.
see? I mean, what is the challenge do you see for the the diagnostics compared to these new gen companies?
Well, I think the physical proximity is the only challenge which they have today, which is the whole reason why they are kind of putting up a shop in every nook and corner. But having said that, the diagnostic companies are taking it region by region. To kind of give you an example, Dr. Lal is extremely strong in North. While they do try and have penetrated in a small way in West, it is very difficult to beat the leadership of Metropolis in a market like West. And when you talk to a Metropolis or Dr. Lal, they do mention that there is still scope of significant growth in their strongholds, like Metropolis in West and South and Dr. Lal in the North. Uh, Again, to kind of give you a number, if Dr. Lal has been growing at 15%, you will be surprised to know that in a mature market like North, which is 30% of the total market, their growth is still at around 13-14%. And I mean, their market share is by no means small. They are the leaders out there by far. So what I'm trying to highlight is that in their regions of stronghold also there is enough room for them to kind of go penetrate deeper, put up franchises in every nook and corner of the city, and kind of keep growing out there.
So similarly, Thyrocare is a very strong brand down south.
Thyrocare has a materially large presence in South, but Thyrocare is slightly different because they are more B2B versus a Metropolis or a Thyrocare, Metropolis or a Dr. Lal, which have a shop with their name.
Right.
Thyrocare will probably deal more with the local labs out there, but your observation is right, where they do have a higher presence definitely down south. In fact, you raised a pretty interesting point where you spoke about the labs going to home. Interestingly, just in March, what has also been passed as the regulation has been on teleconsultations. Now, when we compare this to the West, teleconsultation is growing leaps and bounds. Where in a COVID-19 situation, a patient is unable to meet and visit the doctor, and they are doing, or they are visiting the doctor or meeting the doctor through an online portal. right? It is a little difficult for patients to kind of necessarily accept that, because every patient would like their nerves to be tested by the patient, or them to be inspected by the doctor in general. But this teleconsultation thing kind of got passed in March, and I would believe that at least when we talk about rural areas where actually it is very physically difficult for the patients to visit the doctors, teleconsultation in India, just like diagnostics going to home for home pickups, is going to kind of pick up in a meaningful manner by allowing the doctor to go closer to the patient to their homes.
Wonderful, Tanmay. I think it's been a really very knowledgeable session, and I really appreciate the patience with which you have answered all the questions and given us a perspective of the sector as a whole, from a 18 to kind of 3 years to 5 year perspective, and the whole understanding of what looks good in the near future, and what should be where the investors should be looking at. Thank you for this whole session. I think we don't have much any more questions. So maybe I would like to take this opportunity to thank you again, and thanks SBI Mutual Fund to become a partner in this session, and look forward to doing much more sessions of similar kind with you.
No,
Thank you.
thank you so much for hosting us. It was a pleasure talking to you and answering all the queries you had. Lovely having this
Thank,
interaction.
thank you.
Thank you so much.
Thank you.